Welcome to Cognitive Dose. We are here, as always, curing blind spots and shattering cognitive bias. If you walked into a casino, sat down at a high-stakes blackjack table, and calmly announced to the dealer that you were going to win simply by eliminating all your internal fear.
Yeah, they would definitely keep a very close eye on you.
Right, security would be right behind you. Like if you said you were going to trust the mystical flow of the cards, they'd think you were crazy.
Because, the house edge just does not care about your emotional state. The math is absolute.
Exactly.
You could be the most zen, detached, spiritually centered person in the room, and a negative expected value game will still, slowly and methodically drain your wallet. Your mindset doesn't change the cards.
It really doesn't. But see, if you take that exact same mindset, the idea that psychological mastery is the ultimate overriding determinant of success, and you apply it to the financial markets, you don't get escorted out of the building. You get published.
Wow, yeah. You get a bestseller.
Exactly. And in the case of Mark Douglas, who released the book Trading in the Zone in the year 2000, you get elevated to the status of an absolute legend. In retail trading circles, this book is treated as a foundational text. It sits right on the shelf next to the great financial classics.
It really does.
And as someone who studies the intersection of the human mind and the market, I find his central thesis to be a fascinating, highly structured framework for navigating chaos.
Well, I come at it from a slightly different way. The cultural footprint of this book is undeniably massive, and I completely understand why it resonates with people so much.
Right.
But from a rigorous, empirical standpoint, it requires a severe data-driven deconstruction. When you actually map his framework against modern market microstructure and neurobiology, it operates on profound epistemological failures.
That is a strong claim.
I mean it, though. In many ways, it serves as an ideological enabler for behaviors that we would otherwise classify as deeply destructive.
Okay, well, let's lay out the foundation first so we understand exactly what we are debating here. The core thesis of Trading in the Zone is that trading failures are rarely due to poor analytical skills or bad charting.
Right.
Douglas makes this compelling observation. He says back in the 80s and 90s, traders began shifting massively from fundamental analysis to technical analysis. They had better charts, better patterns, better data. Yet the vast majority were still losing money. Douglas realized that technical analysis gives you an endless stream of opportunities, but there is a massive psychological gap between analyzing a chart and actually executing a trade when real capital is on the line.
He called it the mental gap, which is honestly a brilliant rhetorical pivot.
How so?
Well, it takes the focus completely off the viability of the trading strategy itself and places the burden entirely on the individual's psyche.
But that pivot makes functional sense when you look at how human beings operate under stress. Douglas argues that successful trading is almost entirely contingent upon adopting a probabilistic mindset.
Right, treating everything as probabilities.
Exactly. You have to completely eliminate the fear of loss, and you have to eliminate the fear of missing out. To do this, he introduces what he calls the 5 fundamental truths.
Right, the core pillars of his method.
Yeah, and the most critical of these are the ideas that anything can happen in the market, that every moment is completely unique, and most importantly, that a trader must accept 100% responsibility for their outcomes. If you internalize those truths, you enter the zone. You view money merely as abstract probabilities. You act without hesitation, and you tap into the underlying flow of the market.
Look, I completely acknowledge why this framework is so seductive. I really do. If you are a struggling retail trader bleeding capital, this book promises you ultimate control in a totally uncontrollable environment.
It gives you agency.
Exactly. It tells you that the market isn't beating you. You are beating yourself. And therefore, you have the power to fix it. But we have to be intellectually honest about what is actually happening here.
What do you mean?
Douglas is demanding that traders view the market as a perfectly neutral entity. He claims the market just ticks up and down, and therefore any pain you feel is just your own internal psychological friction. That is structurally false.
I see why you think that. But let me give you a different perspective. Let's look at this through the lens of performance psychology. Think of it like professional golf.
Okay?
The wind on a golf course is chaotic, adversarial, and mathematically unpredictable. A professional golfer cannot control the wind, just like a retail trader cannot control institutional market movements.
Sure.
But if the golfer doesn't achieve a state of flow like a zone, they won't even be able to swing the club effectively. Douglas isn't denying that the market is chaotic. He is saying your execution is the only variable you actually control.
Right.
Doesn't adopting complete, absolute personal accountability prevent the trader from playing the victim and force them to optimize the one thing they can actually manage?
That's an interesting analogy, but I would argue the golf course isn't actively trying to steal your golf ball.
Wow, okay.
The modern financial market is. When Douglas tells traders that the market is a neutral stream of data, he is fundamentally misrepresenting the arena. The modern retail trading landscape is a highly optimized, structurally rigged environment.
You're talking about the algorithms.
Exactly. When a retail trader executes an order, they are participating in a market dominated by asymmetric high-frequency trading. These are systems designed for latency arbitrage.
Meaning they have a speed advantage.
Huge advantage, meaning they can see a retail order, buy the asset fractions of a millisecond faster, and sell it back to the retail trader at a micro markup. The market is quite literally engineered to hunt retail liquidity and trigger stop losses.
But again, if the trader can't change the algorithm, isn't their only recourse to master their own reaction to it?
Accountability is vital, yeah, but demanding 100% responsibility for structural disadvantages crosses the line into psychological gaslighting.
Gaslighting?
Yes. If you sit down to play a game where the opponent can see your cards and you lose, the correct response isn't to blame your own internal belief system. The correct response is to recognize the structural disadvantage.
So you think he isolates the trader?
Completely. By insisting that failure is solely due to an inability to trade your beliefs, Douglas isolates them. He takes the expected statistical outcome of participating in an adversarial, mathematically disadvantaged game, and he frames it as a personal psychological failure.
You are suggesting that this extreme detachment actually creates a vulnerability. But wait, if a trader is constantly terrified of the algorithms you just described, they will never be able to execute a trade. Douglas is just trying to neutralize that terror so they can perform.
I'm not convinced by that line of reasoning because neutralizing natural fear in an environment of true risk is biologically dangerous.
Biological?
Yeah, fear is not a character flaw. It is a biological survival mechanism localized in the amygdala, evolved over millions of years to prevent fatal exposure. When Douglas forces traders to systematically suppress this fear—
To view capital as just probabilities?
Exactly. To convince themselves that capital is just a sterile stream of probabilities, he is dismantling the very psychological circuit breakers that prevent financial ruin.
That's a heavy claim.
We have clinical terms for someone who is completely detached from the real-world value of currency, who harbors an illusion of control over random events, and who continues an activity despite massive financial harm. Like an addiction, it is indistinguishable from the dissociative state of a pathological gambler.
That is a profound comparison, linking the zone to a dissociative fugue state. But isn't the key difference that a gambler is relying on pure chance, whereas a trader in the zone is executing a mathematical edge? Because Douglas is heavily focused on consistency over a series of trades. He explicitly states that you don't need to know what is going to happen next to make money, as long as your strategy has an edge over a large sample size.
And that brings us to the epistemological vacuum at the heart of the text. He uses the word edge, but he actively marginalizes actual mathematics.
Does he? He literally writes in the book that attitude produces better overall results than analysis. I'm sorry, but I just don't buy that. It demonstrates a severe misunderstanding of expected value.
How so?
In quantitative finance, long-term profitability is strictly governed by your expected value, the math of your win rate against your risk-to-reward ratio. If you are operating a system that has a negative expected value against institutional algorithms, applying perfect psychological discipline does not magically make you profitable.
Right, you just lose gracefully.
It simply ensures that you will lose your capital with perfect, detached consistency.
That sounds elegant in theory, but let's look at the flip side. Let's say a trader actually does possess a verified positive expected value strategy, a great analytical model.
Okay.
Even the best mathematical system will fail if the human executing it panics. If I have a strategy that wins 60% of the time, but the pain of my first 3 losses causes me to abandon the system, My mathematical edge is completely destroyed by my lack of discipline.
That's true.
Therefore, the psychology actually precedes the math in terms of practical application. Douglas is trying to solve the problem of loss aversion, which objectively ruins rational decision-making.
That's a compelling argument, but have you considered the biological realities of how loss aversion actually functions? You cannot simply restructure your beliefs to just wish away loss aversion.
It's hardwired.
Exactly. We have empirically validated research on this from Daniel Kahneman, and Amos Tversky. Their work on prospect theory proves that human beings evaluate the pain of a loss as roughly twice as powerful as the pleasure of an equivalent gain.
The classic behavioral economics finding.
Right. This isn't a bad habit you picked up. It is a hardwired evolutionary response operating in the fast, automatic, subcortical part of the brain.
Response with pure conscious willpower.
Exactly. He is asking for a biologically impossible state of permanent emotional neutrality. And what happens when a human being inevitably fails to achieve a biologically impossible state?
They blame themselves.
They get caught in a destructive cycle of self-blame. They lose money, and instead of critically evaluating their strategy's expected value, they think, oh, I just didn't master my beliefs well enough. I wasn't deeply in the zone.
Well, really, it's just biology.
No, you were just a human being with an amygdala reacting naturally to financial trauma.
I think it's important to note, though, that intuition and deep flow states do exist in high-level performance. You see it in chess, in sports, and yes, in trading.
Sure.
Douglas describes a state where a trader taps into the market's collective consciousness to sense future price movements. While the phrasing sounds a bit, mystical, isn't he just describing expert intuition?
You think so?
Like the ability of a highly trained mind to recognize complex pattern recognition without conscious thought?
Calling it expert pattern recognition is giving the text far too much credit. Markets are driven by decentralized algorithms, macroeconomic data releases, and institutional hedging flows.
Right.
There is no neurobiological mechanism that allows a single human mind to somehow sense the collective behavior of algorithmic servers in New Jersey. Quantitative analysts rightly point out that this is unfalsifiable pseudoscience.
So you prefer a more clinical approach?
Absolutely. And modern clinical experts strongly disagree with Douglas's approach. Dr. Brett Steenbarger, who is a clinical professor of psychiatry and works directly with elite institutional traders, argues the exact opposite of Douglas.
What does he suggest?
Steenbarger posits that emotions should never be pushed into a sterile void. They are vital data inputs.
That is a fascinating paradigm shift, treating fear not as a failure of belief, but as an active dashboard indicator.
Exactly.
If you are feeling terrified in a trade, maybe you don't have a subconscious fear of success. Maybe your position size is genuinely too large for your account size. Or maybe market volatility has fundamentally changed the regime you were trading in.
Yes.
The emotion is trying to tell you something mathematically relevant.
Precisely. Your brain is conducting a risk assessment faster than your conscious mind can calculate it. To numb that out is to turn off your dashboard while driving on a highway.
Let's transition to the empirical evidence, because this is where the debate gets really challenging. If the biology of complete detachment is impossible, and if prioritizing attitude over mathematical analysis is flawed, why does the template of the calm, detached trader seem so objectively true?
What do you mean?
Well, when we observe the titans of the industry, the elite quantitative traders, the best hedge fund managers, they perfectly embody Douglas's ideal. They are calm, they are completely unfazed by individual losses, and they operate purely on probabilities.
Okay, I see where you're going.
Causality seems to support Douglas here, right? The most successful people are the most detached.
And there we find the fatal logical error that supports the entire mythology of the book. You are looking at correlation and reversing the causality.
Reversing it.
In formal logic, this is known as affirming the consequent. Let me explain how it works here. If you have a structurally sound, mathematically verified quantitative edge, let's say you have 20 years of back-tested data proving your algorithm works, you will naturally be calm when you trade.
The math creates the calmness.
The math creates the calmness. Douglas observes this calmness in successful professionals and reverses the arrow. He tells retail traders that if they artificially manufacture the calmness, it will magically generate the mathematical edge.
That is a critical distinction. He sees the psychological byproduct of a mathematical advantage and mistakenly identifies it as the root cause of the advantage.
Exactly. Elite quants at firms like Renaissance Technologies aren't calm because they spent years doing belief restructuring exercises. They are calm because they have an infrastructure of supercomputers and PhDs proving their positive expectancy.
Right.
Telling a retail trader with a laptop to just be calm like the professionals leads to manufactured euphoric confidence, and euphoric confidence, paired with a negative edge, leads to abnormal position sizing and ultimate ruin.
But I have to push back on behalf of the thousands of retail traders who swear by this methodology. You can go to any trading forum right now and find countless testimonials from people who state unequivocally that trading in the zone saved their careers. They credit the book with teaching them the discipline they needed to stop self-sabotaging and finally become profitable. How do you account for that massive volume of lived experience?
I account for it through classic survivorship bias. Let's use the famous thought experiment popularized by Nassim Nicholas Taleb.
The monkeys?
Yes. Imagine you put 10,000 monkeys in a room and have them flip coins. Pure randomness. Statistically, a small handful of those monkeys will flip heads 20 times in a row.
Just by sheer luck?
Right. If you take those winning monkeys and interview them about their success, what will they say? If they read Douglas, they will tell you that they achieved a deep state of probabilistic flow, that they eliminated their fear of flipping tails, and that they took total responsibility for their coin tosses.
And because we only interview the winners, we assume their psychological state was the independent variable that caused the success.
Precisely. What Douglas deliberately ignores is the silent graveyard. For every trader who read the book, got lucky, and credited their zone state, there are thousands of highly disciplined, fearless retail traders who perfectly accepted risk, completely detached from their emotions, and still went completely bankrupt.
Because their underlying strategy lacked statistical edge.
Yes, but we don't hear from the bankrupt traders. They walk away in shame, assuming they just didn't master their psychology well enough.
It creates a closed loop. It is an unfalsifiable thesis. If you read the book and succeed, it proves the framework works because you were in the zone.
Right.
If you read the book and lose all your money, it proves you secretly harbored unconscious negative beliefs or didn't fully accept the risk. Because the subconscious cannot be empirically quantified, the theory is completely immune to falsification.
Exactly.
The book can never be wrong. Only the reader can fail.
Which is exactly why many rigorous quantitative professionals have labeled the text as mental gymnastics rather than financial education. It provides pages and pages of circular reasoning about belief systems, but offers absolutely zero actionable mechanisms for tracking data, calculating expectancy, or verifying an edge.
It is purely internal.
Yes. Furthermore, the absolute individualism of the book enforces a deeply insulated, privileged paradigm.
Expand on that. What do you mean by a privileged paradigm?
Douglas insists that financial ruin is merely a psychological construct, that money is just a neutral probability. That assumes a level of Western, educated, affluent privilege, where a devastating financial loss is just an abstract data point on a screen.
Right, like it doesn't affect their real life.
For the vast majority of people engaging with the markets to improve their lives, the fear of losing their capital isn't an artificial construct blocking their self-actualization. It is a literal, existential threat to their livelihood, their housing, and their families.
Yeah, it's real danger.
Treating devastating financial risk as a detached game is a detachment from reality that only the ultra-wealthy can truly afford.
And there is a piece of historical context that adds a layer of irony to this entire discussion. Mark Douglas himself reportedly lost nearly everything he had in the markets back in 1981, which was the catalyst for him pivoting away from trading and becoming a trading coach.
Wow.
The architect of the system theoretically couldn't apply his own psychological mastery to generate consistent market alpha when his own capital was on the line.
It is the ultimate blind spot, and yet the industry continues to canonize the text because it sells the one thing everybody wants: the illusion that you are just one mindset shift away from infinite wealth, regardless of the structural realities of the math.
Well, we have thoroughly mapped the intellectual tug-of-war here today. And as is the tradition on this show, I am not going to tie this up with a neat, happy resolution or suggest that we simply agree to disagree.
Right.
The phenomena Douglas explores in Trading in the Zone attempt to solve the very real, visceral anguish of market participation. The psychological pain that retail traders feel when navigating financial markets is entirely real, and the desire for a framework to manage that chaos is valid.
True.
But as we have explored today, relying solely on psychological detachment operates with massive, unignorable blind spots.
It takes the very real anguish of traders trying to survive in an adversarial environment and offers them a placebo. And unfortunately, it is a placebo that frequently accelerates their financial demise by overriding the very natural biological survival instincts designed to protect them.
Yeah. Douglas's methodology is exactly like putting 10,000 monkeys in a room to flip coins, interviewing the few who flip heads 20 times in a row, and concluding their success was due to their winning attitude and lack of fear. But manufacturing a fearless attitude will never change the mathematical probability of the coin.
Use this insight to protect your capital and your mind. Thanks for joining us on Cognitive Dose. Make sure to subscribe, and we'll see you next time.